and the statistics get worse, like when they realize that in the 60s they still got a mortgage on their home, so the numbers are even like more scary. So all this purpose of this presentation is to create, even if you don't take action today, but just to give you and share that information with you, like as it resonate with you and stick into your mind when you take a further decision to say, oh, I haven't thought about it, like if I will be able to retire comfortably. So that's the way of the purpose, like to share better ideas, smart investment vehicles, so you ended up with a better balance and of course retirement.
You're on mute, Wendy.
Okay. So should I continue with this? Just to confirm what Julian is saying, in Australia, we have 3 ages that people get confused for retirement. So we got the age of 60. That's when you can give up a job and start using the money that you have accumulated in your industry funds. The age of 65, that's when you don't have to give up a job just because you turn 65. You can access the superannuation that you have saved. And by the age of 67, that's when you can access the government pension. The government pension is not for everyone. You have to apply for it, and it's income tested and asset tested. So it's designed pretty much for the people that don't have anything, and it gets reduced year by year.
Yeah,
Okay.
thank you for sharing. I think it's very valuable information as because most of us are between our 30s or 40s or early 50s. We don't even think about this until we actually get closer to that date. But it's something for you to be mindful of. Okay. So I'll leave this to Wendy so that she can actually explain a bit more exactly what superannuation is.
Okay. So in Australia, we have kind of 2 different types of superannuation. So there is one, the industry funds, the ones that someone else manages, makes the decisions, and our input is very minimum. We pretty much say our level of risk. And there is the other option, which is self-managed superannuation funds. It's where you take control and responsibility of your money, and then you start doing those investments by yourself. With the self-managed superannuation fund, you can buy shares, you can buy units, you can buy crypto, you can buy collectibles. There are many, many things that you can do. There are requirements for each type of asset, but the most advantage it is that you can buy property, residential or commercial property, and you can leverage from the bank, so you can grow on a larger asset. So pretty much what Anderson was saying before, like if you have 200,000 in shares, and if you do nothing, let's say in 10 years it doubles, so you can have 400. However, if you use those 200, you borrow from a bank, just buy a property of 500. If you leave it for 10 years, we know, and there is record that usually they double within 10 years. So if you do nothing, in 10 years, it could be 400. If you do something, it could be 1 million. So this is the huge difference when you take control of your own superannuation. And unfortunately, a lot of people don't have knowledge about this strategy. It has been around since 2011 and is going to be taken away from us, finishes on 10 of August. Okay, so superannuation journey, contributions. You can, how you increase your super, it comes from contributions. There are the employer contributions. However, you can also do member contributions, and there are concessional, non-concessional. What I want to bring here is that there are many ways to start putting money into your super if you want to create wealth through super, because the wealth that you create in super, it only pays 15% tax while you are in accumulation. Okay. And then you have two stages. Preservation pretty much is accumulation, is the working years. And then retirement income is when you retire. And that's when you commence a pension. And in a fund, you can have multiple. You can have people in accumulation, you can have people in pension, and our accounting system, we can account for those type of situations. Yeah.
Right. I'll move on to the next one.
Okay, so probably with this one, what I would say is not how much knowledge people have, is how much action they take. I can see so many people that they listen, they go to webinars and they have the strategies there. But if people don't take action, they're not going to get results. And with property, there are different type of properties, as there are different type of investors, and we are in a different paths. So each investment is so unique and different for each person. And if I can leave people with something, is that you need to have a team. It is called self-managed superannuation fund. Yes, you can self-manage it, but you need a team around you. So when you let yourself have that professional guidance, that's when you can achieve better outcomes. Okay, so with self-managed superannuation funds, if you invest outside super, if you do it at your individual level, your taxes can jump to 47. If you do it through a company, it's about 30%. But if you create wealth through super, it's only 15%. People said that, oh, my superannuation, if I put it there, is going to be locked until I retire. But there are many ways that you can use that super now and create wealth at the same time. And that's especially when you are a business owner and if you need premises to run the business. It's an excellent strategy where you can buy the commercial property through super and rent it back to your business. I believe that's the best strategy for self-managed superannuation fund. But of course, there are a lot of information, but I just wanted to know that that is there. And then and probably with this one, the lower returns over time is pretty much with shares. It's there. They try to diversify, so they put something in mining, something in IT companies, and then if mining is doing well, but probably IT not so good, so it compensates, and then it's a steady growth with the years. But a way to accelerate that, it could be through property. And then probably with this one, I'll say some people feel so happy that they are saving, but they are saving in cash. And cash, if you just leave it there with years, is losing value. So if today you were able to buy a Coke with $1, in probably 2 years, you will not be able to buy a Coke with $1. So it is the same with money. People that save the money and use those just to be in the bank account is losing value with time. Okay, next one.
Yeah, thank you so much, Wendy. And to complement what Wendy was saying, this is what a property for frame exactly. That's what we do. So we have a number of people that are working with us. For example, Wendy, from the superannuation perspective, so from the accounting perspective, so she does not only the setup of the self-managed super fund and the structures around it, but she also does the accounting side of it. So the part of the self-managed super fund, when you have a company with it, you need to do the financials every year, and there's a cost involved as well to maintain it. But I'm going to go through that later on. But just complement that as well is not only the accountant, then you also need to take into account the accountant. Simon, for example, is one of, it's part of the Property for Freedom team and one of the mortgage brokers that's helping us throughout the process. So we need to make sure that that's also, we're communicating with each other, especially at the moment where timing is very critical. But we'll go through that soon. All right. So when it comes to superannuation, there's different ways of you can actually use it. You can either go, as Wendy was saying, you can either go the traditional way and use it in shares, in bonds, in cash, but they're not physical assets that you can see. We believe in property because that's something that's tangible. You can physically see it. If there's issues with it, you can physically see it, or you can sell it if that's not performing well. Or obviously that's the last resort, but it's obviously something that you can perceive in future and something that you can see. Whereas share bonds, cash, and items like that, it's very it's not tangible. So people sometimes, when you can't see it, you lose control of it, right? The other part of it is the additional of the leverage, is what I was saying today earlier. If you borrow against that property with the bank, it's not the same when you have a property that grows at 6% per annum on a $600,000 as opposed to a $70,000 superannuation capital that you have in it. There's different perspectives to it, and we'll run through that example shortly. In addition to that, when you have a property, you can also take into account the rental income of it. A lot of the time, that's what a lot of people don't perceive, is that, whilst you're actually getting some buying the property, there's also getting not only the contributions that you're adding to the superannuation fund, but also the rent that you're getting out of that property. So once you buy a property, it's like if you had forgotten it, you buy it set and forget, essentially. So you're expecting it to sell it, whether you want to sell it after your preservation age at 60 years old, and if you want to sell that at that point, or 65, depending on your circumstances, at that point you pay 0% on tax, which is a massive advantage of using a self-managed super fund. And that's what a lot of people, unfortunately only a small percentage of it, of residential property in Australia. In fact, it's only 1% that are buying residential properties through SMSF, because they don't know about these things, and that's something that you can use in your advantage. Yeah. Another positive part of it is that because there is inflation, then rents also increase with time. When you have a look at, for example, traditional investment, there's always that market volatility. So, for example, the war in Iran, there's always issues with the stocks going up and down, right? Whereas with property, there's a very secure asset and there's limited land. We tend to focus on houses rather than townhouses or apartments, because we're a firm believer that land is the scarce part of what people don't have, essentially, and it's always a need. People need to somewhere to live, right? This is one of the main benefits of using buying a property. Right, I'll pass it on to Wendy.
Okay, so what is a self-managed superannuation fund? A self-managed superannuation fund, it is a special structure. Actually, it's a trust with special rules for retirement, for superannuation. It's just a legal entity. The members get control of it. You can have up to 6 members. You can combine the super. They don't have to come with the same member balance. They can have different percentages. And the same how in the industry funds, they do the investments, but everyone has a clear member balance. Exactly the same happens with self-managed superannuation fund, and it has to go to an external auditor each year, and that's what they do to check that everything has been split accordingly with the member balance. With a self-managed superannuation fund, you are in control of it. You take the responsibility. We open a bank account in the name of the super fund where you have control of it. So probably that's why the government doesn't promote this much, because in the wrong hands, if people is not good with money, they can just go out and spend that money. They will face jail for it, but it's there. Like literally the money get transferred into a bank account that you have access. Yes, a lot of rules, but a lot of things that can be done. It is greater flexibility because you decide what to do. So if shares, for example, are not performing, you don't have control on those companies. You can't change anything that is happening there. However, if you choose something like a property, with a property you can paint it, you can do a bit of renovations, you can put it into Airbnb. Like there are many things that you still have control to manage it. Tax effective, because self-managed superannuation funds only pay 15% taxes. And after retirement, it does no longer pay taxes. And any assets that were acquired, if you want to sell them after retirement, there will not be capital gains. So that's huge. So, and it's a nice way to build for your retirement. For example, if you can buy a property and you can keep it until retirement, and hopefully by then it's fully paid, the rent that property is producing, you can start taking that rent as pension without having to sell the asset. If you have it in the opposite in shares, and if you start taking out, well, you will be consuming that capital and then you will be left out with no super. But this is a good way to keep building wealth, and hopefully for some families, if they want to leave something for the next generation, they can do it. So yes, there are a lot of rules about self-managed superannuation funds. And I also want to say, every time that we are talking about money in Australia, we must say that this is education only, and this shouldn't take a place of advice. So you really need a financial advisor to guide you and help you to make the right decisions for you, because here we are talking in general, but I have said it before, everyone is unique, and a strategy that works perfectly for me, it might not work the same for someone else. And the sad news. Okay, so great strategy for self-managed superannuation fund. Use what you have already have in super, combine the super of husband and wife or up to 6 people. Use that as a deposit, borrow, buy residential property, and then keep it and manage it. Very easy way to create wealth for retirement. But with the current crisis that we have for property, and there used to be a lot of incentives for investors to create wealth through property. So the government decided to remove those incentives outside super. And we knew in the industry that it was logic that investors were just going to move and continue investing through super. But they quickly realized that they left that door open, so they closed the door. So last week, first time in 20 years that I see that they changed the law so quickly. So Tuesday, they got together to say that they were going to remove borrowing to buy residential property from self-managed superannuation funds. Thursday, it went to the Senate, and then Friday, it got royal assent and became law. So now we are in a very small window. We got until 10 of August to have the self-managed superannuation fund set up with rollovers, with bank account, and with a signed contract. So at this point of time, if you really want to do it, you have to work with a team, and the team needs to be working pretty much at the same time. Like, for example, I will be doing all the setup of the super fund, the broker will be applying for the loan. You need a buyer's agent at this point. If you try to do it by yourself, you are going to miss out. So you do need a buyer's agent and a property lawyer. So if you work as a team, you might be able to make it. The risk is if you don't make it, you can go back to an industry fund, but you will lose the setup of the super fund. Or if you don't make it for residential property, you can explore commercial property because you can still borrow money to buy commercial property. And this is just a few strategies, but around property, there are many, many ways to do it. So this is just a bit of information because otherwise it will become too much.
And just to complement what Wendy was saying, what we found so far is that because we understand that it's sometimes a bit difficult to try to get all the money together, some people actually pool money together to be able to get what they want to be. So let's go through an example of what typical example will look like in the current situation. So currently for most clients, we're buying properties around the $600,000 mark. So how much super money you actually need? We say it's around between minimum, it's $150,000 to $160,000, right? Why? Where does that figure come from? So if we purchase a property of around $600,000, you need a deposit of at least $120,000 plus additional fees, including the buyer's agent fees, which is around $36,000, right? So if you add these two up, this is going to take you to around 156. So that doesn't really need to come out of your pocket. So for example, if you put all the money together between 4 friends, you only need $40,000 in each superannuation to get where you want to be. So realistically, you don't need cash to be able to get started in the property journey. You only need to have this amount. Even if you don't have 4 people, okay, let's get 6 people together. Let's get 3 families joined together to get the $160,000. So it's not impossible. People can still do it. It's just a matter of how quickly you can actually take action on this. As Wendy was saying, Unfortunately, we've got a very small window to try to get all these across the line, right? So we've done a quick example of what it looks like. Typically, the interest rates are between 7 to 7.5% per annum for this type of loans. And we've done the exercise of a property growth rate of around 8%. Typically in Australia, it's around 6.5%, and it's been like that for the last 30 years. However, the advantage of using Property for Freedom or advice agents is that you can try to increase that growth rate so that you can get faster what you want to be, right? So we've done the exercise over 20 years with a gross rental yield of around 5 to 5.5%. So what does that actually mean in 20 years? So if we do that consistently, we're going to get in 20 years to $2.9 million, right? I think that's an incredible number. That's only on the growth of the property, okay? So what does that mean in terms of rent? If we talk about rent, that will mean $161,000 per year when you get to this number. So it's not about passive income, because by that time, as Wendy was saying, and you achieve pension time by your age, or pension age rather, you pay zero tax on it. So that will be tax free, which is not something that you'll be able to have with a normal salary, right? But let's say you pay off the initial amount and you still owing some money to the bank. Let's say you pay the 387,000, you're still left over with $2.5 million worth of property. That's not something, I can guarantee you, that's not something you can get if you keep investing your money in your current superannuation fund. I think that's the beauty of investment in property. There's other assets out there, as we were saying previously, but property, as it is in most places around the world, is a very safe asset. It's a very tangible asset. If you buy the type of properties, most of the time it's just set and forget. The type of properties we buy, we try to make sure that it needs low maintenance. So the houses are made out of brick, just so that we don't have to spend too much money on it over time, right? That the idea is that we're not only getting money from the rent, but also remember, you're going to keep contributing your existing contributions, which is at 12%, to this self-managed super fund. So you're going to have some money left over, and you can decide whether you still want to, do a bit of a split between buying an investment property, and then, the other 50% you're going to invest it on shares. Then the other 30% that you have left over, you're going to invest it in collectibles. It's really up to you and really how much you're willing to spend. Some other people, what they do, they realize they can still save more money, and then they decide, instead of buying one, they can do some salary sacrifice and then buy another investment property. That's something also people tend to do, but it's entirely up to you. Any questions so far? No questions. That's good. Right. Wendy, I'll leave this to you.
Yes. So self-managed superannuation fund, people said it's not for everyone. For me, I'll say it is for everyone, because we all should have the option to decide about our money. And also because we all should be in charge of our retirement. Like for me, I have kids, and I feel that the best way to show my kids my love is to be independent for my retirement. So at the moment, the government pension, it's only $750 per couple every 2 weeks. So that's like, if you don't own your house, and then pretty much you will pay rent and you will not have money to eat. So for migrants that we came to this country late, it is really, really important that we take control of our finances, that we start doing our best to prepare ourselves for retirement. that is not something that you do 1 or 2 years before you retire. That's something that you start preparing like 20 years before you retire. So probably the people that is here, we are at the age that we should be looking after how we are going to retire. So with self-managed superannuation fund, you have to follow the rules. If you don't follow the rules, there are penalties. And as I said, if you take out that money before retirement, you can face jail. So it is heavily regulated. But yeah, if you are responsible with your money, this is for you. Gives you more control. You can partner with other people so you can grow faster into a bigger or better project. So you can do it with husband and wife. I can see business partners doing together with their spouses. So the only restriction is that you cannot do it with your employees unless they are your family. With any property or any investment, you have to look at long-term investment. So shares and crypto, like shares, they have more, they are volatile. Crypto is more volatile. Property is very small, but pretty much all the properties along the way, they are growing, okay? And yeah, and there are a lot of tax advantages. The ones about commercial property, they are very good. If it is for your own business, a lot of great strategies there that happy to discuss it further. And then next one. Okay, so easy one. So the way to start a self-managed superannuation fund, a lot of accountants, they require a statement of advice to be able to do it, but that's not compulsory. So a statement of advice, it should be only if you are not sure if that's for you, if you are not familiar with properties and finance. So probably the guidance of a financial advisor will be great. And in this one, I must say that you need to look for the right advisor, because financial advisors, they profit from shares. So they tend to put people into shares. If they put someone into property, they lose the client because they're not going to get profit from that property. So if you want that financial guidance, look for a financial advisor that advise on property, okay? So when you are ready, when you have made the decision that, hey, yes, I want to do it. For example, someone like me, we can do the setup of the super fund when we have all the information. It can be very quickly, like within 3 days. In the setup, we do the bank account and we help with the rollovers and all the registration. It is a brand new entity that needs tax file number, ABN, and the registration to receive employer contributions. Then when you are ready, when you find the property, we do the birth trust. At this time, I'm doing it pretty much when I do the setup of the super fund, just to be ready. And yeah, all the compliance, it's when it finishes 30 June, each year it needs financials, tax return, and it needs to go to an external auditor. And then, yeah, so the bank account and rollover, that's pretty much, I'm doing that at the same time, because this is a timeline, but because of the pressure that we have at the moment and the small window, like pretty much we all are working at the same time and doing multiple things very quickly. So yes, you need a pre-approval. I pretty much ask people before they jump into a self-managed superannuation fund to get a broker, someone like Simon, to check on the numbers and see your borrowing capacity. The borrowing capacity for the super fund is completely different to your individual. There are two completely different borrowing capacities. So if you are planning to do something at your individual level, probably you can still do it because the borrowing capacity, it's another legal entity with a different borrowing capacity. And yes, you need a buyer's agent at this point to help you to find the property. Then you purchase, settle, and then you manage the property exactly the same as you do outside super. You can give it to a property manager. You can do it yourself. You are in charge of any repairs, maintenance, and paying all the expenses and collecting the rent. And yeah, and you have to have an accountant that is with you every year so your fund remains compliant.
Correct. I think Wendy's touched on a very, very important point. Although we have until the 10th of August to have an executed contract, so purchase the property, like find a contract, literally. Realistically, if we want to be able to get all those steps together before we actually find the property or purchase it, we advise people to take action by the 10th of July. If you take action after that, there's a very, very high chance that you might not get where we want to be. We don't want to end up rushing finding the property that's right for you. At the end of the day, we may not get the first property as we want to, so we may need to go and find another one. It all comes back to finding the right property for you, that where the numbers make sense, and it all depends on your borrowing capacity. See how many people actually within the fund. If, for example, you got 1.3 million, 1.4 million dollars of borrowing capacity, we won't necessarily suggest to buy one property that's worth 1.4. Rather, split it in two. Why? Right? Because the chances that two smaller properties are going to grow is more than just one. That's not only the reasoning, but just to diversify the risk. Probably we're going to buy one property in Queensland and then the other one in New South Wales. It comes down to finding what's right for the specific family or the specific group that we're finding the property for. And it's different for every family, which is worth mentioning. Right. Okay, I think this is probably the best part where people get to ask questions. There's no silly questions. I know there's a lot of people that don't have a very good understanding of what actual SMSF mean. So don't be shy, ask a lot of questions, anything that you can think of, shoot out.
I think that Paola was asking something on the chat. Paola G said, can two or more SMSF get together to buy one property?
You're on mute, Wendy.
Yes, I was just trying to look for the question, but yes, they can. So, and there are different structures to do it. They can buy the property outside in a company or a trust, and then different super funds can buy shares and units, or they can buy just one property and say 50-50, and two different super funds can buy it. Yes, there are many, many ways to do it.
And there was another question
at
the very beginning from Indira. She said, I heard that if I get a loan from my self-managed super fund, the interest rates will be higher because I am applying as an individual. I am not applying as an individual. I will be applying as a company.
Okay, no, the explanation for the higher interest, it's because when the government wants to protect super. So they said that the super fund cannot borrow money unless it is a limited recourse borrowing arrangement. So we create another layer of protection. So it's called bear trust, holding trust, custody trust. So it's another structure that is going to hold that property that you are buying, and it's kind of creating a bubble that it says the lender is lending and the only thing they can record is that property. So if anything goes wrong with that property, they cannot go outside and start taking the shares or the cash or the other investments that you have within your super fund. So because the lender is taking more risk to lend that money, that's why the interests are a bit higher. But that's the reason.
Is asking maximum 6 people can join to buy a property together, correct?
Yes, maximum 6 people.
And that's the
Kevin is putting
probably
his
to
hand up.
complement
Sorry.
the presentation. That's the beauty of the SMSF, to join forces, because for instance, like a normal individual in their 30s or 35s should have by now balance of 50K, which is not enough to purchase a property. But everyone should have like other friends or family members that we can combine together, like 6 friends. Everyone is contributing 50K. So all combined, we have 300K. And with 300K, we can purchase like two 600 properties, or one like bigger one for a 50 to 1 million. So that's the beauty of SMSF. Join forces is as a saying said, it's better together.
Yes. And
Kevin,
hopefully,
another question. Sorry.
and hopefully the people are with the same mindset and energy, because you all will be responsible and you all will have to act on it. Like, for example, if it is a document to sign, like they all have to sign the documents. And it will be very sad if you start asking like, hey, can you sign the document? Can you do this? Can you provide that? So make sure that the people that you are going to do it together, like you are with the same way or the same energy to create wealth.
Correct. We tend to.
Okay, Kevin.
Sorry to interrupt, Julian. We tend to say that if possible, make sure that the people that you partnering up with, they have similar age, just so that you're all looking forward to similar goals in life in terms of retirement. I think that's where it really helps. And balances at the end of the day, it doesn't matter if you have 30,000 and then the other person has 50,000 and then the other person 60, because at the end of the day, you join as a percentage of your contribution. So that's going to remain over the term of the property. So even if you only have 20,000, you're still better off putting your money in a property rather than not do anything, right? Again, that's another advantage of using an SMSF through property investment.
Yes. Kevin has
Kevin.
a question.
Yep. First of all, thanks for property and Wendy for putting this together. Appreciate your time. A question with regards to something which is not out of control for the rollover process. Wendy, what sort of time frames are you seeing for the rollover and the funds to appear in the SMSF transactional account? Does it vary from different industry super funds? And what time are you allowing for that component of it?
Yes, the industry funds are given 3 days after they have received all the information. So usually you can request the rollover from my Gov account, or if you are with an accountant, we can request it from our software electronically. But when you do it from your MyGov account or from your accountant software, the industry fund gets a notification. So you need to get in contact with them because you need to provide a certified copy of your ID and certified copy of the SMSF bank account to prove that it belongs to you. When they have received that information and it's up to their standards, they get 3 days to do the rollover.
Okay. And if we are in a situation where we don't have time to make the deposit payment, is there any arrangements that you can have to use your personal cash for the deposit of the purchase?
Okay, so two things. You can put the money inside the super fund as a contribution, but that means you cannot take that money out. So if you put it inside the super fund, it's a contribution to the fund. And then from the fund, you can do the deposit. That's one way. But yet, the legislation doesn't allow you to put deposits or do purchases on behalf of the super fund. It has to be with the super fund money. The only thing that they allowed is for you to prepaid expenses for the setup of the super fund, because they understand at that point the super fund doesn't have money. So it's the only fees that they allowed for the members to pay on behalf of the fund.
Sure. Just one more question. With regards to lending or using your money as an equity partner for development deals, is that possible with the super fund?
Sorry, can you say that again? It was breaking up a bit.
Just with regarding using your funds to get into development deals, can you use it as a equity partner to go into a development deal?
So yes, like I guess it is when it is a property and a percentage of the property you want to buy it at your individual level, and the other percentage can be purchased by the SMSF.
No, for example, if I've got is that on my end?
Yeah, for me, it's breaking up.
No, I think it's Wendy's. Maybe Wendy, if you try to mute for a couple of seconds while he talks, and then see if it gets better.
Yeah, can you hear me? Okay, cool. Wendy, the question was if I can use the funds in my self-managed super fund to go into a development deal as a money and equity partner, is that allowed? So instead of investing in a normal residential property, can you go into a development deal?
Now you're on mute, Wendy.
Okay, to develop property, yes, it can be done. There are restrictions to it. And while you, like, for example, if you buy a property and if you have limited recourse borrowing arrangement, well, it is in that bare trust structure, you are not allowed to develop that property. That property needs to be paid out before you can do any changes to that property.
Okay. I think my question was around if you can use it to go, say if Julian is doing a development and he needs some money partners, can I use the funds to go in as a money partner and then get the returns once the development is completed? I hope it makes sense, my question.
If it's like lending money, like if you lend that money to a third party,
Yes.
Someone that is not related to you, like if you know a developer that it is collecting funds to do a developing thing, yes, it is allowed, but it's very risky. But you cannot lend money to yourself to develop a property, no. And a self-managed superannuation fund cannot run a business.
That will be more like a share situation, Wendy. I imagine when you have a developer and they're a company, and then you've got shareholders under that company, and you just investing money in, right?
Yes, you can do it by buying shares, or you can do it alone to those companies where they secure a return to you.
Sure. Awesome. Thank you.
If it's through a loan, you need a loan agreement in place and you need to follow everything. If it is through shares, well, it's just purchasing the shares and having the share certificates and everything as normal.
And the shares, investing in shares is audited as well at the end of the year, or any activity within the SMSF is audited, yeah? Even including the shares.
Everything, every single transaction needs to be supported. That's why accounting for SMSF is a bit more complex, because we have to look into every single transaction, every single asset, and we have to revalue those assets at 30 June. So yeah, it is a more complex type of accounting, very, very regulated.
Sure. Awesome. Thank you.
We have another question from Marcela. What tax deductions can a SMSF legitimately be claimed? What tax?
So remember that a self-managed superannuation fund only pays 15% of tax. So this is huge already. But then pretty much all the expenses of the super fund will be tax deductible. Accounting, audit, any type of expense from the property, any repairs, maintenance. If you need to see a financial advisor to get a better strategy to create wealth or something like that. Even I have seen people that if they want to do a course to learn something about property or shares, they can even pay those courses from their SMSF. So yeah, pretty much all the expenses inside the SMSF are related for the SMSF to create income. So pretty much all of them are deductible.
Okay, thank you. Yeah. We got another question. Edward is asking, if you buy a property beginning of August using a SMSF arrangement, does negative gearing applies to that property?
Okay, so for self-managed superannuation fund, yes, it applies. And what it does is if the super fund is creating losses, those losses are carried forward. So when the super fund is creating a profit, we can start offsetting those losses.
Does that answer the question, Edward?
Any other questions?
Right. There don't seem to be a lot of questions after this. Look, essentially what we're sharing here, if you guys would like to proceed with the SMSF and you would like to have a buyer's agent that will be able to help you throughout the process of acquiring a property, we've attached the QR code so you can book a session with us. And as I said, and Wendy said previously, well, it depends on a case-by-case scenario. So we'd like to get to know you and your situation and see how we can help you get to where you want to be as a family or as a, as friends. It's very important, as Wendy said, to have the right team with you. In that session, it's a 30-minute session where you understand where you're at the moment, how much you've got in your super, and how we can get to where we want to get.
Yeah, from Oscar. Yeah,
I think there's one
go
more
ahead,
question.
Oscar. Unmute yourself. Yeah. Oscar, you can talk now. We cannot hear you. Yes, yes.
Can you hear me now? All right. Can the property, can the equity of a property that is bought in SMSF structure be used to buy a property on a personal name?
No, no. I guess the equity that the property inside the super has created, like to take that equity.
Yes.
Yeah, no. No, what is created in the super fund, it has to stay
It has
there.
to stay there. Mhm.
Yes.
All right. I think that's all we have from our end. Thank you very much for attending and taking your time. I hope you find some insightful information about SMSF, and we're here to give you a hand throughout the process if you guys need some. Look forward to seeing you all. And if you have any questions, you can scan the QR code, send me an email, send us an email, and we'll be more than happy to give you a hand. Okay. Thank you, Wendy. Thank you, Simon. Thank you, Julian, for taking your time as well. And we'll see you in the next one.
Thank you. Bye-bye, guys.